Hello everyone, welcome to iExamP. So in this today's session, we will learn about the new credit loss framework, the expected credit loss framework for the banks, for which RBI has come up with a discussion paper recently. And then various recommendations and suggestions are being invited from the various stakeholders. After that, RBI will come up with the final guidelines for the introduction and adoption of this credit loss framework, expected credit loss framework by the banks. So this is a very important and relevant topic for various examinations. So we will understand about it. So let's proceed. So RBI has come up with a discussion paper on introduction of expected credit loss framework for provisioning by banks. So banks, this is actually a very relevant discussion paper on adoption of expected credit loss framework, because the banks make advances, loans, and against that they make provisions also. So that methodology for the same, there would be some change in that. So this discussion paper is regarding that. And RBI has sought feedback and also recommendations and suggestions from the various stakeholders after issuing this discussion paper, and various inputs have been sought from the stakeholders, and the final guidelines are expected to be notified in the financial year 24, and implementation is expected to take place from April 1, 2025 onwards. So what is this framework all about? We will learn about it. So as we know, banks, when we talk about banks, the definition as a layman that comes to our mind is that banks make advances or loans against the deposits, right? Because banks accept deposits, and out of those deposits it makes loans and advances, right? So in making these loans and advances, banks take various kinds of exposures, and the different categories of exposures, or different categories of these loans and advances, they actually which are susceptible to various risks. And the primary risk involved in such kind of transactions is the credit risk. Credit risk is the risk of default, if we just talk about in a very basic language. So credit risk represents the risk that the loans given by a bank will not be paid in full. If a bank has made a loan to an individual or to business or an entity, and that individual or an entity makes a default in the repayment of the loan, then it will cause a loss to the bank, right? So there is always a risk of that default. So that risk of default by the counterparty is termed as credit risk, and it is one of the primary risk that is involved in the banking transaction. So bank is likely to suffer some level of losses on its exposures, right? Because in this case, like, banks make finance to various ventures, various projects, various ventures. Banks make advances to not only individuals like retail loans and all, but commercial loans also banks provide. So for that purpose, banks take various exposures, and while financing these ventures and projects, that requires a thorough analysis of these ventures, and also it requires a due assessment of their viabilities, whether that project would be viable, whether it will incur losses, or whether it will have profits, it will generate revenue, and then how the viability would be for this project or a venture. That assessment is made by the banking officials when they are granting the loans for the same. So there are various factors which are considered in that assessment. That is, one major is the future projections, because when the project report is submitted, that these are the future projections, that future projected revenue is this likely to be generated from the said projects, right? And also there is an assessment of the state of macro economy that the project would be running in, state of industry which it is working in, how the state, because when the economy changes, when the state of the economy changes, so is there is an impact on various kinds of projects that are running in, and also the impact is different from industry to industry. So that's why these factors are considered while making loans and advances to various kinds of projects and ventures. So while making this kind of assessment, there is always a level of uncertainty involved. Why there is an uncertainty? Because we are making an assessment that involves our biases also, and these assessments are based on the historical experiences of the bank. If the bank has made loans in the past on the similar grounds for the similar projects, what was the experience in the past about the same, so those factors are also keyed in. So that's why, you know, whatever had happened in the past might not happen in the same way as in the future. So there is always a risk involved, because there is always a while making these assessment, there is always a kind of uncertainty which is involved. So for assessment done, the probability of deviation is always non-zero at any point. Probability of deviation means whatever assessment we are making the true assessment or projections of the future, that okay, it will generate revenue, that's why we are granting a loan to it. But there is always a probability of deviation, that is, there is always a probability of loss, that is always non-zero at any point. So banks are likely to suffer losses for the loans and advances that they are making. So for that purpose only, banks make adequate cushion or adequate protection to deal with those kinds of losses in terms of having the provisions against their profits. So whatever profits the bank is having, against those profits they always create provisions, right? So that is what it is, to deal with the credit risk. So types of losses the bank faces. So while to measure this credit risk, there are two categories of broad categories of losses that banks deals with. That is, one is expected loss and another is unexpected loss. Expected loss, as we say, that when bank is lending money to its borrower, it is prepared for some type of losses. It has anticipated that there would be some losses, and those losses are called expected losses. But over a period of time there can be variation in those losses also. So those variation in the losses, whatever bank is expecting, there might be some variation in those expectations. So whatever variation in those losses would be, that is called unexpected loss. So expected loss, if we see that how it is equivalent to probability of default into loss given default into exposure at default. Probability of default, what is the probability of this loan going into a default category, and what would be the loss when the loan is defaulted. So that is not 100% is always loss. So loss given default is 1 minus recovery rate, and what is the exposure when the this default would be made. So this is just a technical, this is expected loss, and the standard deviation of this expected loss is called the unexpected loss, right? So this expected loss is covered by the banks through its pricing policies, like the types of interest, the rate of interest it charges to its customers, and also keeping the loan loss provisions, that whatever provisions bank is making against the profits in order to deal with such kind of losses. On the other hand, unexpected losses is covered by maintaining capital. So whenever we talk about the Basel norms and all, and whenever we calculate the capital as per the different methodologies that are provided for various risks, So that covers the unexpected loss, because expected losses are covered by making provisions and also the pricing policies. So what will happen if these provisions are inadequate? So if these provisions are inadequate in covering these expected losses, then the burden will fall on the capital to take care of expected losses and unexpected losses, which can lead to systemic risk and can lead to overall bank failure. So when these provisions are not adequate to deal with expected losses, because expected losses were not assessed by the bank correctly or for any reason, then what will happen when the provisions are not adequate? Then the bank will resort to the capital. So these losses will eat up its capital. So when any unexpected situation arises and any loss comes in, then it will create a systemic effect. It will create a systemic effect, and then there will be a losses to the whole financial system of a country. So that was quite evident in case of the global financial crisis of 2007-9 also. Right. So this is the way the losses are treated. So how this is currently treated and how this is proposed to be treated, that is a part of this discussion paper and the proposed framework. So extant incurred loss approach. So the approach which is currently dealt by the banks even globally till recently is the incurred loss approach. So what is this incurred loss approach? As the name suggests is that banks are required to make loan loss provision based on incurred loss approach, which used to be the standard globally till recently. So the gist of this approach is bank need to provide for losses that have incurred or occurred. So when the loan is classified as an NPA, non-performing asset, like after 90 days, when till the 90 days when it becomes an overdue, then only an account will be adjudged as an NPA. So then only the provisions will be started to be built by the respective banks. So this is an incurred loss approach. Right, so it can be seen that the event of the classification of loan as an NPA must happen first before the provisions are to be maintained by the bank. But in this course of time, when the account has already started facing financial difficulties, then credit risk for the bank is constantly increasing. So before this 90 days period also, the credit risk for the bank is constantly increasing. So if it is not accounted for and this credit risk remains unmitigated till the regulatory requirement of maintaining the loan loss provision is triggered upon, that happens on the classification of an account as an NPA, so that would be a problem for the bank. So it is ideal situation for the bank that they recognize this increase in credit risk and start making provisions for the losses that would be expected in such exposure at the initial stages only, before the account turns bad or NPA. Right. So as per the existing incurred loss approach, provision is maintained when the account is classified and NPA. Right. So what exactly happened in this case is that a lot of things were evident, particularly global financial crisis, as I had mentioned. Right. So when credit losses are recognized only when they are actually incurred, the value of loan security that the banks carried were overstated, provisions were understated, and banks' capital looked more healthier at that time. That because provisions were understated, loans were not classified as an NPA, problems were not identified at the right time. So that's why they were looking that okay, capital is there, the balance sheets are healthy, everything was going perfectly. But till the time the problem got triggered in. So as defaults exacerbated, they got increased, systemic risk rose, and banks were supposed to hold more provisions. So abruptly banks were supposed to hold more provisions because defaults were occurring frequently, and which ate into their capital. at a time when they most needed it, because there was a rise of systemic risk, and then they needed the capital the most, but the provisions were eating into the capital, and it impacted their capital base because of reduced internal accruals, which affected the overall resilience of banks, and which also actually made various banks to go bankrupt. That was quite evident. So that's why this experience only, the whatever the experience of global financial crisis was there, that only prompted the decision for this G20 and Basel Committee on Banking Supervision to recommend other frameworks, right? So ECL model, that is expected credit loss framework model, formulates a forward-looking approach, and it was adopted by International Accounting Standard Board, and in IFRS, this is accounting standard IFRS 9, and also US Financial Accounting Standard Board, which follows this current expected credit loss framework, which got effecting from 2020. So these frameworks, IFRS 9, International Accounting Standard Board published this IFRS 9 in July 14, which took effect from this 2018, January 1, 2018, and this US Financial Action Task Board, this also final standard they published on current expected credit loss, which took effect from 2020 for most large and mid-sized US banks. So this expected credit loss framework, so that was, I've told you that this is there. So for this, RBI is also planning to migrate it to the same, that is Ind AS, that is equivalent to Ind AS 109. So RBI's own guidelines mention IFRS 9 as the inspiration. So whatever it is signified by IFRS 9, that would be likely to be adopted by RBI. That would also confirm the migration of maintenance of accounts for the banks to Ind AS, which is currently not so. So what is this expected credit loss framework approach? So expected credit loss framework represent the probability weighted estimate of present value of all cash shortfalls from an instrument. Basically, in very easy language term, is a forward looking approach, and banks would have to reserve for losses earlier, on the day asset is recognized in the balance sheet, or every other subsequent reporting date, right? On this date, the banks would allow the provisions to be faced in a timely manner, so that it is able to keep the capital requirements in a proper manner, so that there is no abrupt requirement for maintenance of capital, which is not easy for the banks, and the provisions are required to be maintained in a phased manner. When the account is initially categorized in the balance sheet, and every other subsequent reporting date, the assessment would be made, and the provisions would be changed, increased, or reduced accordingly. So for that, there should not be any burden on the bank's balance sheets to maintain or to add more capital abruptly. So this is the forward looking approach. So whatever cash shortfalls are there, that would be determined, and provisions would be made accordingly. This is this expected credit loss approach. So what exactly it would look like? So herein the decision would be to classify the financial assets in various stages. As of now, the guidelines have not been provided, only the rough draft proposed framework is provided, so that I would tell you. So the financial assets would be categorized in 3 stages. What are these financial assets? Financial assets are loans and advances, including irrevocable loan commitments, including sanction limits under revolving credit facilities, lease receivables, etc. right? Irrevocable financial guarantee contracts and investments that held to maturity and available for sale. So various kinds of investments are there which are categorized as held to maturity, available for sale, or held for trading. So for these two categories, this classification would be there, because this is the category that bank only keeps in its trading book, which is only held for trading purposes. And other thing is that what is this irrevocable means, that this word would be assessed on the existence of contractual clauses. If it is irrevocable, that whatever facilities are provided in terms of that, even off balance sheet exposures would also be considered under the financial assets. But this irrevocable will be considered not only on the basis of contractual clauses, but also on the basis of actual demonstration, that if the bank has not explicitly stated that this particular facility is irrevocable, but in the past, in the historical, like the past event, bank has never revoked it, then it will also be considered irrevocable. So how these categorization would be made, that financial assets that have not had a significant increase in credit risk since initial recognition, or that have low credit risk on the reporting date. So when the this involves those financial assets which do not carry the credit risk, as the repayments are good and every security attached to it and all other things are going good, and there is very less credit risk. So for this, less provision would be required. So for these assets, 12-month ECL is recognized, that is 12-month expected credit loss is recognized for the same. But on the other hand, when it is in the stage 2, that there is a significant credit risk but there is no evidence of impairment, there is an increased risk as compared to the stage 1, but the account will not turn into NPA, or it will not get impaired, that bank is not able to recover anything. So for these assets, lifetime expected credit loss is recognized for undertaking for contributing towards provisions. And for stage 3, there is an objective evidence of impairment, that there are likely losses that bank might have to incur on these kinds of assets which are provided in the stage 3. So for these assets also, lifetime ECL is recognized. So that's way all these as financial assets will be categorized in different stages, and the necessary provisions on the initial recognition and the subsequent reporting date would be made. So other relevant information which is provided in this discussion paper is that it is proposed to implement an expected credit loss approach for loan provisioning to scheduled commercial banks, excluding regional rural banks and also cooperative banks. So as of now, this discussion paper has also given some information that if stakeholders feel that certain category of cooperative banks with certain threshold of deposits can be included in this framework, then suitable inputs can be made. And the methodology and the basis of computation of ECL is central to Ind AS. So as I have told you that this is actually related to IFRS 9, that's Ind AS 109, that would be adopted with this expected credit loss framework. So that would actually complete the migration of banks towards Ind AS. So what had happened is that in 2016 also RBI had initially notified that there would be implementation of Ind AS from 2018 onwards for the banks, and also the procedure was also provided for the same, but it was subsequently deferred. But with this adoption, it will finally migrate to Ind AS. And the difference between the accounting provisions held on adoption of ECL approach as on the effective date and the provision computed as per the extant provisioning norms may be allowed to added back to the common equity tier 1. So we know that in Basel norm there are 3 segments of capital. One is common tier 1, and then is additional tier 1, and then is tier 2. So this is the core capital of a bank, which includes share capital and other statutory reserves. So whatever the difference would be there in maintaining the provisions under the new approach, and whatever has already been made, whatever the difference would be there, can be allowed to be added to the capital, so that whatever requirements are there and that needs to be maintained by the bank in maintaining this common equity tier 1, that can be met. This benefit shall be phased out over a maximum of 5 years. So the timeline is also suggested for what period this benefit would be provided. And also it is proposed that each bank will be permitted to design and implement its own models for measuring expected credit losses, for estimating loss provision. So we know that in credit risk, in Basel norm, there are internal rating based approach, there are standardized approach, and various under internal rating based approach, banks can adopt their own models in computing the credit risk, the capital required, and the provisions required for maintenance of capital risk. So that is different. But in case of provisions also, for estimating provisions also, banks can adopt various methodologies and various models. So RBI will come up with the guidelines and suggestions for the same, on what grounds and on what basis these methodologies can be adopted when the final guidelines are announced. Right. So this is actually a very good period for banks to adopt this proposed ECL framework, because banks non-performing loan ratios are likely to touch very low since the last decades by March 2024. So with this further improvement in profitability and the adequate capital cushion available in the near term, so this is the right and apt time for the banks to implement expected credit loss approach based provisions. And given their capital cushions, most banks will be able to make an early transition towards this new regime. Right. So this is the way it is the proposed. So this particular what we have discussed, the different stages also, then assets will be categorized. So there are also some conditions which are highlighted, that loans will be classified in these various stages as per their credit risk profile, because this stage, as I told you, this will require more provision, this will require further more provision, right, as compared to the incurred loss approaches. So this will be a benefit for the banks in order to maintain their robustness and resilience in the wake of any disruption in the economy. So that's why this is very important framework. So that is it for today. So once the final guidelines come to the fore, we will be discussing in detail about that as well, and also we'll be providing the comprehensive details about the same. So till then, all the best for your preparations. Thank you. So prepare 50% faster with iExamB. Don't forget to subscribe to the channel and press bell icon. And also on this available information, you can contact us if you have any query regarding any of the courses provided by us. So thank you.